What $750,000 buys you in the DMV with the FHA 203K loan? A $750,000 budget can buy you the polished house everyone else is chasing, complete with the finishes you did not choose. That same budget could put you in a better location, give you a stronger floor plan, and leave room to renovate the property around the way you actually live. But a $650,000 fixer-upper with $100,000 worth of work does not automatically become a valid $750,000 FHA 203K deal. The purchase price, renovation scope, required reserves, after renovation appraisal, and monthly payment all have to support one another. Miss one of those pieces, and the house that looked like an opportunity can become the property you cannot finance. I am going to break down how I would evaluate a $750,000 total project in Washington, D.C., Prince Georges County, and Montgomery County. More importantly, you will see why the lowest price fixer is not always your smartest option. Comment below with the part of the DMV you are considering, because location changes how much of your budget should go towards the house and how much should remain available for renovations. For this example, I'm treating $750,000 as your target for the purchase and plan rehabilitation before calculating your exact closing costs, prepaid expenses, or lender-specific charges. That distinction matters because many buyers start with the wrong number. They get approved for a certain purchase price, find a property near the top of that range, and assume renovation funds can simply be added afterwards. With the 203K, your lender evaluates the complete transaction. The program combines the purchase and eligible rehabilitation into one FHA insured mortgage. Renovation funds are then held in the escrow account and released through an approved draw process as work is completed. You do not receive one large renovation check at closing and manage the money however you choose. That structure is one reason the program can be useful. Instead of buying the house with one loan and searching for separate construction financing later, you're building the planned improvements into the original transaction. It also means the renovation cannot be treated like an informal project you figure out after getting the keys. The work has to be defined. Costs must be supported. Your lender needs the required documentation before closing. Now let's look at 3 ways a $750,000 project could be structured. The first version is a home price near $700,000 with approximately $50,000 allocated towards improvements and related rehabilitation costs. This might work when the house is structurally sound, but needs updates such as flooring, appliances, paint, windows, or manageable kitchen or bathroom renovation. A limited 203K can currently support up to $75,000 in total rehabilitation costs for eligible non-structural work. That limit is not necessarily the same as a $75,000 contractor estimate, because the rehabilitation calculation can also include applicable fees and reserves. That is where the buyer can get caught. You might receive a $72,000 construction proposal and assume you are safely under the limited 203K cap. Once the required contingency amount and eligible project expenses are included, the total calculation could exceed the program limit. Your options may then involve reducing the scope, bringing in additional funds under permitted terms, negotiating the purchase price, or determining whether the standard 203K structure is more appropriate. Do not wait until the final stage of underwriting to discover that your renovation category was wrong. The second version might involve buying around $650,000 and reserving close to $100,000 for the rehab. This is where you may begin addressing more than just dated finishes. Perhaps the kitchen layout needs to be changed. The electrical system may require meaningful work. A basement could need substantial improvements. Structural repairs, additions, or major remodeling can move the project into a standard 203K, which requires an FHA-approved 203K consultant. HUD does not place a separate maximum renovation cost cap on the standard version, but the completed property still has to satisfy applicable FHA mortgage limits and valuation requirements. The third structure places more of the budget into the renovation. Imagine purchasing around $600,000 and roughly planning $150,000 in construction, fees, and reserves. That could create the most dramatic transformation, but the larger scope introduces more places for the transactions to fail. A major renovation needs realistic pricing before closing. The proposed work must support the finished value And your team has to understand how the project will be funded as each phase is completed. This is not the same as hiring someone for a private renovation after you already own the home. Under the standard process, the consultant prepares a formal work write-up and cost estimate. Bids are submitted to the lender, permits must be obtained before applicable work begins, and draw releases occur as completed phases are inspected and approved. That draw structure affects your contractor as much as it affects you. A contractor who expects a full project amount up front may not be prepared for a 203K. Someone can perform beautiful renovation work and still struggle with lender documentation, draw timing, change orders, inspections, or the cash flow required between approved payments. When I review a potential project, I'm not only asking whether the work can be completed. I also want to know whether the scope can survive the financing process. Now let's apply these structures across the DMV. In Washington, D.C., you may be deciding whether to spend most of your budget on a finished property or accept an older home in a location that better fits your commute and lifestyle. The renovation route can give you more control over the interior, but location premiums may leave less room for the construction than you expected. A home that needs $150,000 in work is not automatically a bargain because the list price looks low. Older properties can also uncover conditions that are not obvious during a quick showing. Plumbing, electrical service, roofing, moisture, previous additions, and permit history can change the scope quickly. That does not make an older DC home a bad purchase. It means the opportunity has to be measured before you fall in love with the finished version. In Prince Georges County, your budget may allow you to consider a larger detached home, more land, or community where the same total investment goes further toward the physical property. That can create an attractive 203K opportunity when the home has strong fundamentals but dated interiors. The trap here is over-improving. Spending heavily on luxury materials will not force the finished appraisal to match your construction budget. A renovation can be valuable to you without adding the same dollar amount to the appraised value. The plan needs to respect both your personal priorities and the surrounding comparable properties. Montgomery County presents a different calculation. You may be prioritizing access to a particular area or accepting a smaller, older, or less updated home to get there. A 203K could help you improve that house instead of paying a premium for someone else's renovation. Still, the purchase and construction costs have to fit beneath the finished value supported by the appraisal. HUD's 203 calculation uses the property's appraised value subject to completion of the proposed repairs and improvements. A detailed scope does not guarantee that the appraiser will assign the value that you need. Suppose you agree to pay $625,000. Your complete rehabilitation calculation brings the project to $750,000. If the finished appraisal supports only $710,000, you do not have a $750,000 financing solution simply because that is what the project costs. The purchase price, scope, financing amount, or cash structure may have to change. That is why the after-renovation value cannot be an afterthought. It is one of the central numbers in the entire deal. By the same token, an appraisal above your total project cost does not mean that you should immediately expand the renovation. Your borrowing limit, qualification, county loan limit, and lender guidelines still apply. FHA mortgage limits are set by location and updated annually. So the exact property address has to be checked before you build your strategy around a particular number. At this point, tell me what side you're leaning towards. Would you rather pay $750,000 for a completed home and move in quickly, or purchase below that amount and use part of your budget to create what you want? There is no universal correct answer. A move-in-ready home may be worth the premium when your schedule is tight, the existing layout works, and the renovation risk will create more stress than value. The 203K route becomes more compelling when location matters more than finishes. You can see past cosmetic problems, and the proposed work solves meaningful issues rather than replacing perfectly functional materials for appearance alone. Your monthly payment also deserves more attention than the renovation total. Financing the work through the mortgage can reduce the need to pay for the entire project out of pocket, but those costs still become part of the loan. Your actual payment will depend on the final finance amount, interest rate, FHA mortgage insurance, property taxes, homeowners insurance, and any applicable association costs. Do not compare a $650,000 fixer with a $750,000 completed home using list price alone. Ask your lender to compare the complete estimated payments and cash required for each path. Temporary housing can affect that decision too. If the home cannot be occupied while the work is underway, you need a realistic plan for where you will live and what the arrangement will cost. The most expensive choice is sometimes the project that runs longer than your budget can tolerate. Reserves provide another layer of protection. A contingency reserve exists because renovation estimates are prepared before every wall is open and every hidden condition is known. Treating that money like an optional upgrade fund defeats its purpose. If the project stays on budget, ask your lender how unused funds will be handled under your specific loan structure. Do not make assumptions based on someone else's 203K experience. By now, the picture should be clear. A $750,000 budget does not tell you what house to buy. It tells you how much room you have to balance four competing priorities: location, existing condition, renovation scope, and finished value. The right fixer can give you access to a home you might have ignored because it looked outdated. The wrong one can consume your entire construction budget, fixing problems that never improve the layout or lifestyle. Before making the offer, I want the proposed work tied to real costs. The lender should understand the structure early. Your contractor must be prepared for the documentation and draw process. Most importantly, the house needs to make sense before the new kitchen, flooring, and finishes are added to the picture. A 203K loan is not a way to make an overpriced property affordable. It is a financing tool that can help you buy the right property and complete eligible improvements through one mortgage when the numbers support the plan. If you're considering a fixer-upper in DC, Maryland, or Virginia, comment with your target area and the renovation you will want to tackle first. Subscribe if you want more practical guidance on 203K loans, construction costs, and how to evaluate DMV homes beyond the listing photos. Blessings.